Hi, this is Nilus Mattive from Money and Markets TV. We've seen a lot of choppy market action recently. A historic rally over the first 3 months of this year, followed by a big drop last week. But I think it's much more instructive to take a longer view. For example, March 9th marked the third anniversary of the last bear market low. And in those 3 years, the S&P 500 rose 102.5%. That's an average annual gain of roughly 34%. And it demonstrates the kind of profits you can make with good and nerves of steel. But if you look back a bit further, the charts are much different. Since the last bull market high of October 9th, 2007, the broad market is actually down 12.5%. And if you go back another 5 years to the bear market bottom in 2002, the total market gain is only 76% and change. In other words, timing has a lot to do with performance. And practically speaking, it's almost impossible to call those tops and bottoms. But there are ways around that problem for average investors. The first has to do with the concept of sector rotation, the workings of various types of businesses in relation to economic cycles, the broad market's performance, and each other. Take utilities, for instance. Through March 4th, utilities in the S&P 500 had risen 55%, underperforming the broad bull market by half. But if you go back to the longer period from the 2002 bottom, they've risen 129%, far better than the broad market. Another factor to consider is the dividend difference. If you add in dividend payments, those utility companies ended up with a total return of 231% since the 2002 low. Even over shorter periods, dividend payments can give you a much bigger margin for investment error or market gyrations. Just look at financial stocks. Over the same 10-year period since 2002, they lost 20% as a group. But once you add in dividends, they end up even. The bottom line is that you can't let a headline performance figure or short-term market move force you to make knee-jerk reactions in your portfolio. And by the same token, you can't get overly confident that you've been doing a lot better than most other investors either. Meanwhile, there's very strong evidence in favor of strategies that consider major timing issues, sector rotation, and the performance-boosting effects of dividends. That's why all three of these factors remain critical to the approach I use in my Income Superstars portfolios. I'm Nilus Mattive from Money and Markets TV. Thanks for watching.